Hello everyone, welcome to the market opening bell on Tuesday, December 16th, your 10-minute guide to the stock market. US stocks fell last Friday at mainland China's three carriages data for last month's underperformed expectations. Hong Kong stocks followed the external markets downward, with the Hang Seng Index opening 258 points lower. In the morning session, the decline narrowed to 152 points, reaching a high of 25,824 points, but in the afternoon it widened to 367 points, hitting a low of 25,609 points. For the full day, it dropped 347 points or 1.3%, closing at 25,628 points. The Hang Seng China Enterprises Index fell 161 points or 1.8%, closing at 8,917 points. The Hang Seng Tech Index dropped 139 points or 2.5%, closing at 5,498 points. The total market turnover for the day was 204.2 billion Hong Kong dollars. Southbound funds net bought 3.654 billion Hong Kong dollars worth of Hong Kong stocks. Among them, net purchases included Xiaomi at 1.382 billion, Ping An Insurance at 1.19 billion, Meituan at 547 million, China Life Insurance at 350 million, Alibaba at 304 million, Yangtze Optical Fiber and Cable at 177 million, and China Construction Bank at 104 million. Net sales included Tencent at 774 million, Hua Hong Semiconductor at 555 million, China Mobile at 550 million, SMIC at 434 million, and CNOOC at 416 million. According to statistics, Southbound funds have net bought Xiaomi for 12 consecutive days, totaling 12.15 billion Hong Kong dollars. Net bought Meituan for 4 consecutive days, totaling 4.629 billion. Net sold SMIC for 5 consecutive days, totaling 1.985 billion. Net sold Tencent for 4 consecutive days, totaling 2.49 billion. Net sold Hua Hong Semiconductor for 3 consecutive days, totaling 1.547 billion, and net sold CNOOC for 3 consecutive days, totaling 1.401 billion. Technically, the Hang Seng Index has once again fallen below the 100-day moving average. As mentioned yesterday, the 100-day line has lost its significance, with the most important support level still at 25,145 points and the key resistance level at 26,265 points. The tech index rebounded near the 250-day line last month, hitting a low of 5,361 points on November 21st, while the 250-day line was around 5,347 points at the time. Currently, the 250-day line is around 5,425 points, very close, so be cautious of a breakdown. If the 250-day line is broken, the next support levels are 5,360 points and 5,130 points. The three major Asia indexes opened lower and remained weak, with fluctuations throughout the day, closing down 0.6% to 1.8%. The Shanghai Composite Index closed at 3,867 points, down 21 points or 0.6%. The Shenzhen Component Index fell 146 points or 1.1%, closing at 13,112 points. The Chinese index dropped 56 points or 1.8%, closing at 3,137 points. The combined turnover in Shanghai and Shenzhen was 1.7746 trillion yuan. The central parity rate of the renminbi against the US dollar was lower by 18 pips from the previous day at 7.0656 to 1 US dollar. Mainland China's three carriages data all underperformed expectations. In November, the value added of industrial enterprises above designated size grew 4.8% year-on-year, below the expected 5%, marking the lowest since August 2024. Total retail sales of consumer goods grew 1.3% year-on-year, far below the expected 2.8% and the lowest since December 2022, representing the smallest growth in nearly 3 years. According to the National Bureau of statistics. After the Central Political Bureau meeting on September 26 last year, a series of consumption-promoting policies were introduced, leading to a high base in the same period last year, which also significantly slowed last month's retail data. For the first 11 months, national fixed asset investment fell 2.6% year-on-year, a larger decline than the market's expected 2.3% and wider than the 1.7% drop in the first 10 months, marking the largest decline since June 2020. Among this, real estate development investment fell over 15% year-on-year. The fixed investment data for the first 11 months has declined for 3 consecutive months, mainly affected by factors such as the real estate downturn. As for November, the urban surveyed unemployment rate was 5.1%, in line with market expectations. Additionally, in November, residential property sales prices in 70 large and medium-sized cities generally declined month-on-month, with a year-on-year decline widening. The 3 carriages data indicate an overall economic slowdown with weak consumption and investment. Looking ahead to 2026 policies is expected to maintain expansionary fiscal stimulus, with the deficit rate maintained or raised to about 4% and continued issuance of local debt, and focusing on boosting domestic demand and structural reforms. In terms of notable stock movements, Ping An Health bucked the trend and rose 7.4%. On the news front, a series of promotional meetings titled National Pilot Project for Innovative Integration in Preventing and Controlling Major Chronic Diseases, High-Quality Workplace Health Management Pilot Work have been held successively in Shanghai, Nanjing, and Guangzhou since late October. This is not just a series of meetings, but an important national-level practice aimed at systematically addressing workplace health issues. The national project selected Ping An due to its unique finance plus healthcare comprehensive service capabilities. In the pilot work covering East and South China, Ping An will specifically play 3 key roles: resource integrator, data enabler, and model co-creator. The core logic of high-quality workplace health management is to drive 3 major shifts in corporate health management, from post-event claims to pre-event prevention, from universal benefits to precise interventions, and from cost center to value creation. The value of this system lies in its customizability and scalability. Whether in Shanghai's service industry, Nanjing's manufacturing sector, or Guangzhou's high-tech enterprises, high-quality workplace health management can provide tailored solutions based on industry characteristics and employment structures. This is exactly the model that the national pilot project seeks to verify and promote in different scenarios. Hong Kong's third child concept stocks rose against the trend, with Jinxin Fertility up about 4% at one point, and dairy stocks also performed well. On the news side, the National Medical Security Work Conference was recently held in Beijing. The meeting required that in 2 to 6 efforts should actively adapt to population development strategies, promoting the development of maternity insurance and long-term care insurance. It aims to include flexible employment personnel, migrant workers, and new employment forms into the coverage of maternity insurance. It will reasonably increase the medical expense coverage for prenatal checkups, striving to achieve basically zero out-of-pocket for individuals within the policy scope nationwide for childbirth. This measure aims to reduce the burden of childbirth, but whether it can significantly boost fertility willingness remains to be seen. Additionally, starting from January 1st to 6th, the mainland will cancel the value-added tax exemption for contraceptive drugs and devices, beginning to levy the standard tax rate, usually 13%, which is seen as an indirect means to encourage fertility, but has sparked intense public discussion, with experts concerned about potential public health risks. Today's newly listed stock, Xia Technology, stock code 26555, closed at 37.8 Hong Kong dollars in the Glade market on Philip Mart yesterday, up 88.1% or $17.7 from the listing price. Excluding handling fees, each lot of 100 shares would yield a paper profit of $1,770. Xia Technology is a Chinese energy storage industry provider of renewable energy solutions and products focused on research and development and providing energy storage system solutions and products to clients and end users. Its energy storage system solutions and products serve and cover various application scenarios such as large-scale power generation site, large grid site, commercial and industrial and residential applicable to both the Chinese and overseas markets. U.S. stocks fell slightly as investors look forward to mild U.S. inflation data and strong economic activity to be released this week, shifting investments to economically sensitive sectors such as consumer discretionary and industrials, while also buying healthcare stocks. The fear index fixed rose 0.76 points or 4.8% to 16.05. The Dow Jones fell 41 points or less than 0.1%, closing at 48,416 points. The S&P 500 dropped 10 points or 0.2%, closing at 6,816 points. The Nasdaq fell 137 points or 0.6%, closing at 23,057 points. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, dropped 168 points or 2.2%, closing at 7,582 points. Tesla CEO Elon Musk confirmed that his robo-taxi is undergoing testing in Austin, after which the stock rose nearly 5% at one point, ultimately closing up 3.6% at $475.31 US, just about 1% away from its all-time high of $479.86 US set on December 17, 2024. According to Forbes, Musk has become the first billionaire in history to reach a net worth of $600 billion US. In October last year, he became the first to exceed $500 billion US. Previously, it was reported that his startup, SpaceX, might go public at a valuation of $800 billion US, and with him holding about 42% of SpaceX shares, the valuation would add $168 billion US to Musk's net worth, pushing his total to over $600 billion US. Nvidia rose 0.7%, Oracle and Broadcom, which plunged net last week, remained weak, falling 2.7% and 5.6% respectively. Microsoft dropped 0.8%. Netflix, two co-CEOs elaborated on the company's acquisition of Warner Bros. Discovery, which owns HBO and others, promising to maintain Warner Bros. Films in theaters, addressing market concerns that Netflix would prioritize a streaming-first model. They cited Nielsen viewership data, noting that after a merger between Netflix and Warner Bros., the combined viewing market share was still be lower than YouTube's and also lower than a potential merger between Paramount and Warner Bros. The National Association of Home Builders, NAHB, Wells Fargo Housing Market Index, reflecting U.S. home builders' confidence, rose 1 point to 39 in December, the highest since April. However, the index has remained below the 50 break-even point for the 20th consecutive month. The NAHB also mentioned economic uncertainty and potential buyers holding off due to affordability issues as tracking factors. Our stock pick today is Eternal Beauty, stock code 6883. Eternal Beauty engages in the retail, wholesale and distribution of perfumes, skincare products, makeup, personal care products, eyewear, and home fragrances in China, including Hong Kong and Macau. It primarily generates revenue by selling and distributing products procured from third-party brand licensors. The group possesses a vast and diversified portfolio of iconic brands, encompassing not only perfumes but also makeup, skincare, personal care products, eyewear, and home fragrances, with the products mainly originating from Europe, Japan, and the United States. As of September 30, 2025, the group's external brand portfolio covers a total of 74 brands, including 53 perfume brands, 22 home fragrance brands, 17 skincare brands, 10 personal care brands, 8 eyewear brands, and 6 makeup brands. In addition to managing external brands, the group is actively developing its own brand Santa Monica. Building on the existing series, it launched 5 upgraded perfumes and 2 fragrance candles in 2025, taking the first step into the home fragrance sector, which will further enrich the own brand product portfolio. The group sells to over 400 cities in mainland China, Hong Kong, and Macau through distributors, and more than 8,000 online and offline self-operated and retailer points of sale. Perfume Box is the group's self-operated retail brand, encompassing online stores and offline sales channels, primarily selling perfumes and fragrance-related products directly to consumers in Perfume Box stores. As of September 30, 2025, the group has opened 7 Perfume Box offline stores nationwide, covering strategically important Chinese cities such as Shanghai, Shenzhen, and Nanjing. The layout strategy focuses on core areas with strong consumption power and high fashion awareness, aiming to accelerate brand image establishment and market penetration. The group continues to adhere to the multi-brand plus omni-channel business model, building a widespread sales network and consumer touch-points through comprehensive brand management and omni-channel sales services. As of September 30, 2025, the group's membership has exceeded 2.5 million people. In an increasingly competitive market environment, the group strives to overcome the impact of market price wars on its business through cost optimization, operational efficiency improvements, resource allocation to high-growth areas, and actively introducing diversified brands into the market. For the 6 months ended September 30, 2025, operating profit increased by 21.2% year-on-year to 164 million yuan, while profit grew by 15.3% to 133 million yuan. China's olfactory economy has developed rapidly in recent years, with the importance of perfumes in consumers' daily lives continuing to rise. According to Frost & Sullivan data, China's perfume market is expected to reach approximately 44 billion yuan by 2028 and will maintain steady growth. The group will pursue a dual-track parallel development approach. On one hand, continuing to expand its international brand portfolio with a focus on introducing more leading international high-end home fragrance and niche fragrance brands. On the other hand, continuing to build a systematic own brand incubation platform to cultivate a diversified brand matrix with market competitiveness. Its stock price has been consolidating between $1.83 and $2.25 for nearly half a year. If it confirms a breakout above $2.25, it could target $2.5. Suggested buy price $2.15. Stop loss $2. I do not hold the aforementioned stock.